to tuning in for our Money Mondays. We haven't had one lately. As you know, I've been taking care of my mother, and it's hard for me to be consistent. But Myrna uh, agreed to share her wealth of knowledge. I knew that it would be beneficial, and so here we are. Just to give you some information about her, in 2001, after working in the airline industry for 22 years, while she was still employed, she started Phoenix Training and Development. It was designing, developing, and facilitating programs for teen women and young adults on financial literacy, uh, entrepreneurship, and leadership. And so that would help her as she once she retired, she took a volunteer position with the YMCA of Greensboro, and she facilitated a college readiness program, and that volunteer position turned into a full-time 9-year position where she was recognized for her collaboration with the Center for Creative Leadership, and she co-signed a 4-year youth leadership program that obtained $497,000 from the Office of Juvenile Justice and Delinquency Prevention. So we definitely want to educate people because, in this case, you were educating youth because you didn't want them to be delinquent. To be a delinquent, and we're going to educate some adults because we don't want them to be delinquent in their bills.
That's right.
So today, Myrna continues to educate and empower women, investors, small business owners, and tailor solutions to reach their financial goals and manage assets. She is a financial advisor with Edward Jones Investment. So glad to have you here.
Thank you, Roslyn.
Our topic tonight is the financial road to, how did we entitle it? Financial road to success?
Well, just rules of the road.
Rules to success.
Yes.
Right.
Yeah.
So I'm going to let you go ahead and jump in. And if we have any questions, if any pop up again, we'll address them. And if not, we can address them later. If this application doesn't allow us to. Okay. Good deal. So look, I got my pen and paper. I'm getting ready to take you some notes too.
Well, thank you for having me, Roslyn. I will tell you, this is my very first social media presentation. I am excited.
Oh, well, we're excited for you.
I spent a lot of years in the training department in the airline industry, but it was always face-to-face facilitation. So let's get started because I know it's the late in the day and people don't want to be on a presentation for a long period of time. But I think it's very appropriate for the civil times that we're in now, to talk about financial empowerment, because that is where our empowerment and our independence comes from. Your financial ability to navigate the unexpected. So when it comes to investing, people oftentimes want the latest and the hottest stock tip and making their money just grow overnight. But investing is a long-term process, and it's something that is not just done overnight unless you are day trading, and day trading is a full-time job in itself. But there are some rules of the road for investing for those who want to take it step by step in the long-term process. And the first rule of the road is to develop your strategy and develop a strategy. And this is not a solicitation for business, but mainly a solicitation to help. Now, we hire professional help for a lot of things. As a female, we oftentimes will hire personal trainers to help us get in shape, okay? Because that's important. But when it comes to our finances, we're reluctant to hire professional help. And that is very important because that is what that person does every day. And they can help you develop a strategy to meet your goals. So that's the first rule of investing, is develop a strategy. People oftentimes say, well, I'm investing because I want to make money. Well, that doesn't have an end goal. You just want to make money. How much money? So if you don't answer some questions, you never know whether or not you reach your goal. Okay, so developing a strategy is the first thing to do in terms of investing. And when I say develop a strategy, what are your long-term goals? What is it that you're trying to achieve? Also, the length of time that you're going to be investing is important, as well as your comfort level with risk. And we'll talk a little bit about risk a little bit more. So those are the things that a professional advisor can help you determine. Can help you determine your comfort with risk, can help you determine what tools are appropriate for the amount of time that you're going to be investing. And it can also help you set some long-term goals if you haven't done that before and if you don't know how to get started with that. So also, an advisor can help you determine what type of trade-offs you may need to make in order to reach your goals, because there's always some trade-offs that have to be done. Sometimes we have to say no to something else in order to say yes to achieving our goals. So know that most times, absolutely. So know that there are trade-offs, and you have to decide what things you're willing to trade off or sacrifice in order to meet your goals. Rule number 2 is understanding that risk. And generally, risk and return generally go hand in hand. The amount of risk you take can oftentimes determine the potential gain. So looking at the amount of risk that you can take is very important. People oftentimes want to tell me what their coworker or what their neighbor is investing in. And oftentimes we want to invest in the things that sound really good, you know, Amazon stock or Apple stock. Well, let's take a look at what your risk tolerance looks like. And the way I explain risk or help people understand risk is like rides in an amusement park. There are a lot of different rides in the amusement park to give you different types of thrills, so to speak. Now, I loved roller coasters at one time, those that go way up and come down and go backwards and come back. I could ride that ride in my 20s. Got on a roller coaster in my 40s. It was a different story. It was a different story. So it's like that roller coaster that goes upside down and goes backwards. There's also a mousetrap. Okay, there's a more moderate roller coaster that can still give you a pretty good ride. You can still say you had a good time at the amusement park, but it's not going to bring up your lunch. Okay, and then you have merry-go-rounds that just go round and around. Maybe the horses go up and down a little bit. So there's a ride in the park for everybody. All the rides will give you a different experience. That's the same way it is with assets, with investments. There are stocks that will make you bring your lunch up. You know, you can get your statement one day and 1 month, and it's like, whoa, my money doubled in just a couple of months. And you can get that same statement a few months later, and it's half of that. So just like that ride that goes up, it can come down very quickly also. But you may not need to take on that much risk to reach your goal. You may be able to ride a more moderate ride, more moderate investment, kind of slow and steady to reach your goal. So that's why it's important to sit down and develop that strategy, find out how much risk you're comfortable with, and kind of go from there.
And would that determine, I know your goals would determine your strategy or would impact your strategy, but would it differ for someone that, for example, is planning on retiring in 10 years versus someone that has, 25 years?
Absolutely. That's where we talk about in that developing the strategy piece, how much time are we working with? Okay. Also, it's going to determine how much risk you're going to take. If you've got 25 years before you are reach your goal, you can afford to take a lot more risk because you've got time. You've got time, okay, for the investments and assets to work, to go up and down and to come down. When you're looking at retiring within 10 years, or let's say within 7 years, we're being a little more moderate because you don't have as much time. Okay, so it's a different type of strategy when you're close to retirement. The focus then is on saving as opposed to taking more risk in investing.
Okay.
So rule number 3 is diversifying for a solid foundation. And when I say diversification, diversifying doesn't necessarily guarantee against loss, and it doesn't always guarantee a gain. Okay, but diversification really means really not putting all your eggs in one basket, having investments in each different asset class. And when I say asset class, I mean stocks, bonds, mutual funds, and different types of investments. Okay, so by that, the market responds to what goes on in society. The market is very emotional. So there are often things that we cannot control, we cannot predict, and just come out of nowhere that the market will react. So that may be terrorist activity. So you think about 9/11. It could be a natural disaster in some part of the world. It could be a health pandemic, like what we're experiencing right now, and the market reacts. So when your portfolio is well diversified across different asset classes, it reduces the volume of swings in value in your portfolio. If you had everything in one basket and the market is experiencing volatility and large swings, you're going to feel it a lot more than if it's diversified across several asset classes. So that's the benefit of diversification, and that's really the foundation of any portfolio.
Okay.
All right, let's move on. I don't see any questions on the side of my screen. Are you seeing any?
No, I don't see any.
All right.
And I'm typing some notes as you give the steps. I'm also putting them in there.
Okay. The next step is sticking with quality. And when I say sticking with quality, quality is one of the most important aspects of investing, because quality is measured by the steadiness of earnings of a company. Okay. If a company is not solid and has erratic earnings and performance over time, the likelihood of them being able to pay dividends and meet their obligations to you as a stockholder are not as credible as a company who has steady earnings and performance over time. So quality is important. Okay. It also means that those investments have the financial strength and the backing and over time, again, to meet their obligations to their stockholders. Oftentimes we are tempted to invest in the investment of the day. And there are always investment fads that come and go. But I caution people about dumping money into things that come overnight, because they can be gone overnight just as well. And to stick with those companies that, I mean, nothing is a guarantee, okay? If you go back 20 years ago and you look at Kodak, Kodak was a solid company, had a great product. Technology changed the way we take pictures. Okay, so that really just put Kodak almost out of business. They are still in business. Their main business now is photocopiers and whatnot, but taking pictures was their main line of product. So sometimes there are things that can happen to a company that have nothing to do with their management or their product or service, but times change and technology can change the way that we do business. Okay, so I don't mean like that, but I mean some of the investments that come up that I would say carry a little more risk. And I won't necessarily say they're not quality investments, but in terms of having the track record, every couple of years is something different. So
It is. I want to jump in and ask you a question, because when you're talking about buying quality, well, being a novice, sometimes we don't know what quality is, and we do just kind of go with the flow.
Yeah.
And so I wanted your opinion on Bitcoin.
Okay, that was going to be the first one I answered. Bitcoin. Okay.
Oh, okay.
So Bitcoin is a digital currency. Okay, it's not built on any economic foundation. It's not built on economic policy. And being digital, you can't touch it. And there are some generations that are more comfortable with digital platforms than others. Okay, so I would say Bitcoin is probably something that could be used with play money, so to speak.
You're comparing it to play money?
I don't know. I'm not comparing it to play money, but it should be, just like if you're going to Vegas and you're going to gamble, that shouldn't be your bill or retirement money. That's
right.
money.
Okay, I'm following you.
So same with Bitcoin. That should be money you're going to play with. For me, when I invest in something, somebody needs to be accountable. I need to talk to somebody. I need to touch something. I need to be able to call somebody and ask questions about this investment. That's not the case with Bitcoin. It's strictly digital. Now, Fidelity does have a exchange traded fund that has Bitcoin in it. Okay, so you can get, there are some companies now starting to carry an ETF, um, an exchange traded platform that you can get Bitcoin in. But moving on from Bitcoin, what are some of the other investments of the day, so to speak, that you've heard people mention?
Well, I don't know, because it's all, I don't know the proper terminology, but it's all still digital products. So it may not be Bitcoin, but it may be another digital product.
CBD oil or marijuana stock.
Oh yeah, look, oh yeah, the weed.
Yes.
Yeah, the weed.
Marijuana stock, carrot bars, you know. So every couple of years, there's a different investment that people get excited about, that people jump on board, and the first few people in make a lot of money, you know. So then people jump on it because they have this fear of missing out. But
yeah,
you're looking for a long-term a strategy for retirement, a long-term strategy. Stick with quality.
but wait a minute. Oh, don't you think weed is long term? Look,
So
folks been smoking it for a while now.
okay, so here are the risks with marijuana stock. Not regulated. Okay, so the regulatory policy is not there. It is still being vetted in terms of investors, where you can, the investment platforms where you can invest in it and see a return on your investment. It's going to be quite some time before you are able to actually invest. There are some marijuana stocks out there that you can buy on the Canadian exchange, and there are a few on the US exchange. But in order to be listed on the NASDAQ, your company has to meet certain financial criteria. None of the marijuana companies can meet that criteria just yet. Okay. Now, there are some pharmaceutical companies that produce the CBD oil that you can invest in.
Oh, okay.
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 There are some other details that I would look for in a stock, a quality stock that I'd be putting into my retirement portfolio, even my wealth building portfolio, that I would get to long before I get to the marijuana stock. I'm looking for dividends. Okay. I'm looking for a track record of growth. Again, some of the investments that carry a little more risk would be slated for my play money. They would not in the portfolio where I'm seriously building wealth.
Okay.
So that's my take on that. Okay, moving on. Invest for the long term. And this goes back to, I think, something I mentioned earlier. There are some short-term investments, because we do have people who like to day trade. That's just what they like to do. And some people do that with their long-term money. Okay, but investing for the long term is, a lot of times people try to time the market, jump in at a certain time, jump out at a certain time, and chances are you're losing money because you can never get the timing just right to jump in. Now, certainly there are times that are more appropriate to buy when the market dips, but you buy while it's low, and then you hold it for the long term. So like I mentioned initially, investing is a long-term strategy, because compound interest is a beautiful thing, and it takes time for compound interest to work.
Mm-hmm. Okay. Look, what is it? Eighth wonder of the world?
Yes.
Yeah.
Okay. So the next rule is having realistic expectations. Okay. And
that's after buy quality.
No, that's after invest for the long term.
Okay, wait a minute. Okay, so it was diversified, buy quality, invest for the long term.
Yes.
Okay, and then what's and you would consider the long term 10 years or more?
7 to 10 years.
7 to 10 years. Okay.
And you can invest for the short term, because there are short term goals that I would say are from 0 to 3 years. Then you have midterm goals from 4 to 7 years. 7 years and out is considered a long term goal. And there are there are different investments that are appropriate for each of those time frames.
Okay. Well, I do show a question, and it's pertaining to long term. Um, and we kind of touched on it, but I don't know if it fully. So it says, is it better to stay diversified or take more risk if you plan on retiring in 20 years? I'm age 50. Would buying fractional stock a good idea for my daughters like Apple, Google, or even hemp?
Absolutely. And fractional stocks, yes. We call that dollar cost averaging because when you buy fractional shares, each time you buy them, you're buying them at a different price. And at the end of the buying period, let's say you were buying $100 a month each for 12 months. So each time that you buy stock, it's going to be at a different price each month because the market is going to move. So at the end of the 12-month period, when you average out the price of the stock or the number of shares that you have, you'll find that you've paid a lower price per share. So yes, buying fractional shares for your daughters is a good idea. Now, if you are retiring in 20 years, you still have some time to take some risk. However, I still would not advise you taking more risk than you are comfortable with. Okay.
Okay. And when you say fractional stocks, that means fragmented. I mean, you're buying some now, and then you'll buy some in a month, and you continue to buy. Is that what fractional means?
No, fractional means, let's say you're investing $100 a month, and the stock that you're buying is actually $110 a month.
Okay.
$110 a share. So it will buy 3/4 of a share. Okay.
Right.
And the next month it's going to buy another 3/4 of a share. So it'll add to that. Then you'll have 1.5 shares, so to speak. So that's what the fractional shares is about.
Okay. Okay. Well, thank you.
Okay.
Okay. So invest for the long term.
Okay.
And then what's the next one?
Having realistic expectations.
Okay.
And having expectations about how your investments perform over time can have a big effect on your strategy. Okay. And also, your expectations should be based on your asset allocation. And when I say asset allocation, that means what percentage of your portfolio belongs to stocks, what percentage belongs to bonds, which percentage belongs to mutual funds. Okay.
Okay.
So when your return expectations are based on how your portfolio is laid out, market environment and things unexpectedly don't throw you off kilter because you know how it's laid out, it's diversified, you're investing for the long term. We've kind of set your expectations that yes, it is going to fluctuate within this percentage based on your risk tolerance. Okay. So that is why it's important to set clients' expectations and not say to them, okay, you've got this stock and now it's just going to do well for the next 20 years. The market, again, if you remember, I said the market is very emotional. It's reactionary to things that go on in society. So your value may fluctuate. So depending on whether you have that roller coaster in your portfolio, whether you have the mousetrap or the merry-go-round, that's where I set that expectation to let clients know, okay, now you've got all this Apple and Amazon stock, expect your portfolio your value to fluctuate. Expect it to fluctuate because these stocks have a lot of movement with market, good and bad. So it's about setting those expectations. Now, if a client has more Procter and Gamble, something that doesn't really fluctuate a whole as widely as, let's say, technology, then I can set that expectation. Your portfolio is only should only fluctuate within a certain percentage range. Okay. Over here on the merry-go-round, where we have bonds that hardly fluctuate in value at all, that's where my most conservative clients are. So it's important to set that expectation so clients don't think that they have one that they're riding on a merry-go-round and lo and behold, their Amazon stock or Apple stock or whatever kind of technology stock is going up and down like that roller coaster. And then they're upset and don't understand why their portfolio balance is fluctuating from month to month. It's because they think they're on the merry-go-round, but they actually have wild cyclone roller coaster in their portfolio. So it's important to work with clients and set their expectations. Okay. So that's one.
So when you say set their expectations, as you get closer to, because you said like 7 to 10 years would be considered long-term. So if you're under 7 years, is there a ratio of stocks and a ratio of bonds? Or like, for example, would you say no more than 40% in something that really is going to fluctuate? Or is there a percentage?
So the percentages change, yes, through different stages of your life. As you get closer to retirement, yes, we that's why we meet on a regular basis, because seasons change. And as you get closer to retirement, yes, those allocations will change from maybe 50% to 60% to 70%, a little more towards the merry-go-round, to be a little more conservative and to preserve that principle.
Okay.
Okay.
Yeah, makes sense.
It's running low. No, don't do that.
What, your phone?
No, on my computer it says battery running low. I'm like, what?
Oh, okay.
I'm going to plug it in right now. Okay. So the next one is maintaining your balance. Okay. And again, rebalancing has to do with diversification, making sure your portfolio is balanced and diversified.
Uh-oh. I guess the computer went out. But let me type in maintain balance while she gets her cord. And I can state that, wait, bear with me. Let me be sure, because I still show her.
Making sure your portfolio is balanced and diversified.
Okay. So I'll give her time. But when she said balance, she is talking about, I was thinking that she meant maintain your emotional balance, because you knew you were going to see, things going up and down. And so then that just might make you feel fearful. But I think she meant maintaining a balance in the account. I mean, not a balance in the account. For example, if you've decided that you want to go 60% in bonds and 40% in stock, you always want to kind of make sure that you're maintaining that balance, because as the stocks grow, things change, then you kind of need to be sure that you're tweaking it. Looks like she's back, and let's see. There you are.
We talked about this old dog trying to do new tricks in this technology, right?
Yes, and it doesn't take long for that computer to die. When it tells you, it's pretty much over.
And I thought I had it fully charged, but anyway, fortunately I had the plug right here. So
okay, but yeah, so we just talked about maintain a balanced portfolio.
Yes,
it's where you left off at.
And that can help you stay on track in reaching those long-term goals. It's just like anything. At the beginning of the presentation, I talked about how sometimes we hire a fitness trainer to help us meet our fitness goals. That fitness trainer doesn't just lay out a plan for you and say, okay, I'll see you in 12 weeks. No, you're meeting with them on a regular basis so they can track your progress to see what they're doing, how close you are to reaching your goal, and if you're making progress. If you are the same weight after 4 weeks, then they make adjustments. We need to burn more calories, we need to adjust your nutrition, something. So it's the same way with your investment portfolio. You don't just set it and forget it, because things change in our life. Sometimes we may transition from one job to another. We may add a family member, someone may pass, we may get divorced. All of these life-changing events can have an impact on our long-term investment strategy. So it's important to review that strategy every so often. And that time to reviewing that depends on you and your advisor. I have some clients that I touch base with every month, some once a quarter, some every 6 months, some once a year. So it's really individual preference in terms of how often we stay in touch. Make sure you're still on track to reach your goal, and if not, making that adjustment. And we make adjustments sometimes based on the market, because sometimes, like I mentioned, people think they can take riding that roller coaster until we have an unexpected event. Okay.
Right.
When we have an unexpected event that causes the market to react, that's when they, I can't take that. So we make that adjustment so that they don't have as much risk and their account value is not having that fluctuation, that large swing. So
And it makes a difference, especially because with women, us being caregivers, traditionally we've been known to live longer.
yes,
And so we actually do need to be more mindful of our situations because
absolutely.
it changes more frequently.
Not only do we live longer, so traditionally throughout our lives, we earn less. Even for doing the same job, we earn less. So
Right.
what's good? Guess what else is going to be less? Our Social Security benefits are going to be less because they are based on your lifetime earnings. Okay, so we're living longer. Okay, we earn less. So it takes some
Yeah.
strategic planning to work that out. Okay, most women at some point in their life will be completely responsible for taking care of themselves. Okay,
Look,
there
wait,
we go.
let me raise my hand.
Yeah. Because you go from daddy's house to somebody's house, either your house or your husband's house. Okay, and most women are the longer livers out of a marriage. And if you divorce or never marry, there you go. We are still the ones to turn out the lights at the end of this thing called life, pretty much. So it takes some strategic planning to make sure that we are economically empowered and financially self-sufficient so that we can take care of ourselves. And with today's healthcare and access to healthcare and what we know about nutrition and exercise, we're living well into our 90s.
Yes.
Yeah. And so
Yeah.
while we should be healthy, I don't know about anybody else, but I don't want to be working at 90. I don't intend to be working at 90.
No. I don't want to
I
be a Walmart greeter.
don't want to be any kind of breeder.
I don't want to be any kind of greeter.
Okay.
So yes. Do have a question. What is the
Sure.
recommended percentage of income to save for retirement?
Okay. So again, that goes back to, let's ask a couple of questions. What type of lifestyle do you want in retirement? Okay. Some people may intend to travel the world and see America and do all the things that they didn't have an opportunity to do, perhaps while they were raising their families or working or caregiving. So the income you need in retirement is strictly going to be based on what type of life you intend to live in retirement. Now, maybe you're going to stay a little closer to home, work in the community. Maybe you're spending more time with your grandchildren. So your income needs might not be the same as the person who wants to travel the world. So that's where you work with an advisor and say, okay, let's envision yourself. What do you see yourself doing in retirement? And then kind of back that out to how much income you will need. Okay. So again, that's an individual thing. But what I will say about retirement and finances is not just the income that you are needing in retirement, but saving, having that, and that's my next rule, preparing for the unexpected. Having that cash bucket of emergency funds is crucial in retirement, particularly if you are going to be living on a certain amount of income each month, because any unexpected event can throw your budget and your retirement into a tailspin, whether it's a new roof on your house, whether it's a hot water tank. Roslyn and I already talked about that new roof. Okay.
Yes, we did.
Anything in society can happen that can throw your budget off. So having that emergency cash, now I know some eyebrows are going to raise when I say this, but while you're working, we recommend 3 to 6 months of income for emergency cash. In retirement, I recommend a year's salary. So whatever your salary is, I recommend your salary and your savings account for your savings. And as daunting as that might be, it can be done. You just have to make the decision. We talked about trade-offs at the beginning of the talk. What things, when you get really focused about something, you'll be amazed at the things you can do without in order to meet your goal. So, it may take you a couple of years, but I have never met anyone who has said to me, I saved way too much money. I don't need all of this.
Woo, yeah. Look,
So,
that's a thought.
yeah. So
Mm-hmm.
you get close to retirement as opposed to investing aggressively to try to make up for lost time, I would suggest that no, because you don't have the time to regain that if the market is not friendly. So invest moderately to conservatively towards your goal and your risk tolerance, but save aggressively. Build that cash bucket like it is nobody's business. So that's what I would, yeah. Also, review your insurance options, your life insurance, long-term care insurance, because again, as females, we tend to be the caregivers and the longest livers. Well, then who will be there to take care of us should we need it? So that you can save for that, or you can insure against it. Okay, because we know for sure, even if we do live to 1995 and we are healthy, there are still some things we may need assistance with. So there are certain types of insurance policies that can provide care for you while you are alive. And it doesn't have to be a terminal illness. 6 daily living activities, can't do several of those, could be a qualifying event. So I'm happy to talk with anyone about those. But reviewing your insurance options, making sure you have a nice sized bucket of emergency cash are ways you can prepare for the unexpected. And when I say prepare for the unexpected, let's say you're in a car accident and God, this may sound morbid, but things will be fine if you die. You won't need any care.
Yeah.
Yeah, life insurance policy to take care of those you leave behind. But what if you don't die? You just
Right.
just
Because you'll be worth more dead than you are alive.
if you just get hurt real bad and end up disabled, then what? So those are the kind of things that I talk to clients about, being prepared for those unexpected things. We can prepare for those things that we know that are coming, but how do we prepare for those things that are unexpected? Because those are the things that tend to throw our finances into a tailspin, those things that we haven't planned for and we don't expect.
Right. Exactly.
All right. Focusing on what we can control. And this is a huge stressor for a lot of people. They get really panicky when the market is up and down. This past March, we didn't have basketball, but we certainly had March Madness. Okay. The market was free fall. It seemed like every day. And it was very stressful for a lot of people. But what I tell clients is there are some things you absolutely cannot control. We cannot control the market. We can't control taxes. We can't control money policy. But focus on the things that you can control. You can control how your portfolio is diversified. We can control how much debt we carry. Okay. So if we can control how much we save. So if we focus on the things that we can control, that will give you a lot of peace of mind at the end of the day. You can focus on your savings. You don't have a lot of debt, not carrying a lot of debt. So even if you lost your job, I got my savings I can fall back on. I don't have an exorbitant amount of bills to pay. Okay.
Right. Got my hand raised.
Exactly.
Yeah.
So focus on the things you can control and don't worry about the things you can't control, because you're just making yourself sick worrying about the market, worrying about taxes, worrying about monetary policy. We can't control any of that. So focusing on those things will help. And then the last rule is reviewing your strategy on a regular basis. We talked about this already. Staying in touch with that financial advisor, making sure you're still on track to meet your long-term goals, and making sure that what you're doing is appropriate for your risk tolerance, making sure your portfolio is well diversified to withstand those various market swings and different things that occur that are unexpected in society. And I'm convinced that all of these steps will give you some peace of mind at the end of the day. Reviewing your strategy on a regular basis, you can see whether you're on track, and that would give me peace of mind. Oh, okay, I'm doing pretty good. I am on track to meet my goal of sending my child to college. I'm on track to meet my goal of retirement. And if you're not on track, reviewing that strategy every so often lets you know what adjustments you need to make to get on track. Again, that will give me a peace of mind that, okay, I just need to make some adjustments. I need to save a little bit more here, cut this, cut that. You know exactly what you need to do. So those 9 tips, I think, are crucial to getting started with investing and staying on track. And if you want me to run through them really quickly again, just developing your strategy, understanding risk and how much risk is appropriate for you, diversifying your portfolio for a solid foundation, sticking with quality, investing for the long term, having realistic expectations, maintaining your balance, goes back to that diversification, preparing for the unexpected, focusing only on what you can control, and reviewing your strategy on a regular basis.
Wonderful. You did touch upon something that I need clarity on.
Okay.
How many years does Social Security average in order to determine your benefit? Or do they go for the last
It's a
3 years of your employment, or do you know?
Well, I know when you get Social Security, it's a certain number of credits that you have to have. I believe it's 64 credits. And your benefits are based on your lifetime earnings, not just
Okay.
a few years. It's based on your lifetime earnings.
Okay. Okay. Yeah, because I was thinking if my benefits are based on my lifetime earnings, I'd be okay. But
Oh no, they're based on.
as you get older, you potentially could be earning less. So then I wouldn't want it to be based on anything that's not going to be, bring me in a decent amount.
Yeah. So you can go to ssa.gov, Social Security Administration.gov, and set up a profile. Okay, it's free. And they encourage everyone to do this several years before you are ready to receive benefits, because the administration has all of your work record. If it's tied to your Social Security number, they have all of your earnings from when you first started working. And they can give you a pretty close estimate as to what your benefit will be at each benefit age 62, which is the earliest that you can claim Social Security, 65, and then if you're born after, I believe it's 1958, it's 66, and then it's prorated. Some is 66 in 3 months, 66 in 10 months, and so forth. But it will give you an estimated rate of benefit at each of those ages. So that way, also, if you do that soon enough, then you can start to factor that into your strategy as part of your retirement income. Say, okay, I'm going to be using that Social Security amount as your base, so to speak. Using what you add to that, if you're fortunate enough to have a pension or a defined contribution plan, letting that be the next leg in the stool. And then your 401k being the third leg in the stool. Okay. So I encourage people to go to ssa.gov as soon as possible so that they can estimate what their benefits may be.
Yeah, they used to send you a statement yearly, but they no longer do that.
Right. Well, they encourage people to go online and do it now.
Yeah, you have to go online.
It's possible.
Yeah. Okay. Well, I see one other question. Is your Social Security affected by divorce?
Okay, that's a good question. It can actually be a benefit. Okay, so if you and your spouse were married, you were married to someone at least 10 years. And this is a strategy that I encourage well, it's not appropriate for everybody, but you can actually claim your spouse's benefit at 62 and allow yours to continue to build to your full benefit age, and then you can switch to your benefit. So,
Oh, so you're actually switching over.
mhm, mhm.
Okay, that
Because
makes sense.
the longer you wait to take your benefit, it's a eight, I think it's an 8% step up
Mm-hmm.
here, okay, till you get to your full retirement age. So it just depends on who was the highest salary earner. It's not always the husband. It could be the wife that was the largest salary earner. And then the husband has that option as well to take
Okay.
to claim hers, and it would be 50% of whatever her benefit is at that time.
Okay. Okay. Well, that's good to know.
There are some different claiming strategies for divorcees as well as for widowers. Okay, so I
Mhm.
encourage people to give me a call. I'm happy to talk with you about that. I have some more detailed Social Security information in my office. And then the administration also can give you details on how to claim the best strategy for you if you've divorced.
Okay. Okay. This has been so helpful and informative.
I'm
In
glad.
fact, that was one of the comments. It says, "This has been so helpful, ladies. God bless you both. Thank you and have a great week."
Thank you. Thank you. I think it's important. This is one of the things that we just don't get. And the reason why I got involved with finances, I started teaching financial literacy, like Roslyn stated, to middle school girls. And it just grew over the years to high school girls, college girls, and now big girls. Um, but we don't, I don't know about the rest of you out there on Facebook. I wasn't taught investing growing up. I was taught to save.
Mhm. No, not invest.
No one taught me how to make it grow. So I think it's imperative that as women, we learn how to make it grow. And it's a lot of information. So I have taken it upon myself to help women make sense of investing. It's the foolproof way to grow your long-term economic self-sufficiency in the market. I won't
Mhm.
mark this for everybody, but it's for most people. And I think we don't do because we don't know. And I think the more we know about it, the more comfortable we will become with it. So the more
Yeah,
educated,
the less fear.
yes, absolutely.
Mhm.
You dismiss that fear, but with knowledge. Okay. So I do webinars, several a month, in just educating women on investing. This one was just a really high level on some of the basic rules of investing, but I do get a little more detail in just stocks and specifics, mutual funds, life insurance, and different things like that. So
And
again,
we're gonna have you come back.
okay, okay.
Yeah,
Again,
yeah. We're gonna have you come back because we need the more in-depth level information as well.
and oftentimes we just don't know we can participate in things even with our work finances, with our 401ks and IRAs. We may be participating in them, but don't ask me how it's doing or whether it's allocated right and just the right things to do with it so that we reduce our tax situation and whether to move it, whether to leave,
Right.
whether to roll it over. So it's all just for lack of knowledge. So we have to get this information out there so that we can not be saying good morning, welcome to Walmart, unless that's what you'd like to do. And
Or
I'm not,
meet
and
Pam
I'm
at
not knocking.
PNW.
And don't get me wrong, I am not knocking that. That is honest work. And if there are tons of people who work in retirement because they
Mhm.
want to, and that is great. But no one wants to be working if you don't have to. If you didn't have,
Right.
if you did because you want to, not because you didn't have the information you needed to put something in.
Exactly.
And you don't have to make $100,000 to invest and grow something for yourself. It's not about the amount. It's about consistency and being serious and focused about meeting your goals.
Right. Exactly. I always equate it to weight. And I tell myself this, although I don't necessarily follow it. If you exercise or walk or monitor your eating every day, then the weight will come off and it won't feel so
Restricted.
Like the goal, right? So restrictive, and the goal is unachievable.
I can't do anything. I can't eat anything. Yeah. Yeah.
Right, right, exactly. So
Mhm.
yeah, that makes a big difference.
It does.
Uh, oh, okay. Marche said she's sorry. She's late. She was doing her taxes. Well, you can always catch the replay because she did drop several great nuggets to us. So, Myrna, tell everyone how that they can reach you.
Okay. So, of course, you know, you can Google me. My last name is Wigley, Wigley. Myrna Wigley Edward Jones, and I'll come up. I'm located in High Point, North Carolina, but my information also is area code 336-812-8000 is my office number.
Great, wonderful.
All right.
So,
Email.
Myrna,
My email.
oh, sure, go ahead.
Myrna, Myrna .Wigley, Wigley @edwardjones.com. And it costs nothing to talk to me.
Okay, I see some people saying that they definitely will.
Okay.
Yeah, exactly.
Make sure
Because
they mention where they heard me.
I didn't hear you.
Make sure they mention where they heard me.
Yes, yes. Let them know that when you speak with her, that she did the presentation in the Faith Elevation and Prosperity group.
Yeah.
So, Myrna, we're going to ask you to come back, and you and I will just talk about the details a little later,
Okay.
so we can get more knowledge, because you have dropped the seeds that we need to build upon, and
This
we
is great.
thoroughly
I
appreciate it.
enjoyed this. Yes.
Yeah.
Didn't have to
Okay.
drive
Good deal.
anywhere. I have to just make sure my computer is charged up, right?
Oh, I have mine plugged in, because
Yeah. I know from
if
now
I
on.
don't, yeah, if I don't, it's a wrap.
Yeah. Okay.
Okay, we gone. You have a good evening now.
Thank you. You too. Thank you so much,
All
Ross.
right.
We'll
You're
talk.
welcome, and thank you.
All right.
Bye
Bye-bye.
bye. Okay, good deal. So, if you enjoyed Miss Wigley, Wigley, first name Myrna, and she is in the group. So if you post a question, you can tag her and she will answer the question. And I am going to have her come on to do some other things. This is like the first of what she'll be providing. So I'm glad you enjoyed it. I know I thoroughly did. Okay, good deal. I'm gone now. I got to go over to my mom's. Take care of her. All right. See y'all later. Have a good evening. Bye for now.